Welcome back to Cambridge House Live. I'm Vanessa Collette here at the Vancouver Resource Investment Conference, and we're joined by Danielle Park. She is the President and Portfolio Manager for Venable Park Asset Management and also author of the book and blog Juggling Dynamite. Welcome, Danielle.
Happy New Year.
It's great to see you. Now, a lot of people were surprised by this sharp decline we've seen in the oil price, but I don't think that you were. I think that you were saying recently even that you thought oil was going to go back down to its pre-consumer credit bubble levels, about the $10 to $40 range. Is that right?
Well, my general thesis is that these things were all influenced by the madness and mayhem in credit derivative markets in the past decade, and that consumer credit and the futures trading that went on at the investment banks that were able to do things like load up on commodities, trade the derivatives, the futures, all sorts of things, artificially made the prices of these things go far above what was realistic on a demand supply kind of model. And so now that that stuff is in retreat and they're starting to leave many of those businesses which they ought not to have been in the first place, you're starting to see leverage come out of the system. The Fed's QE program winding up is another leading edge of that. And as all that sort of false demand comes back out in the form of deleveraging, that's why I think you're seeing a lot of these things drop with breathtaking speed, and that's really taking people by surprise because they had assumed it was a narrative about growing China or something like that. And in fact, I think that had very little to do with what went on in prices in the past few years.
What's the alternative narrative that you think people should be following?
So I think the narrative now, and I'm hopeful that this is the case, is a little more sober and a little bit of reality check about what central bankers can actually do. I think we're starting to doubt the mythology that central bankers are magicians, and that's a very positive step, Vanessa.
We saw it just recently with the Swiss, unpegging their currency from the euro.
Right. So people saying, oh, they shouldn't have done that. That was so abrupt. Well, arguably they shouldn't have tried to artificially support the currency for that long, for 3 years, spending a fortune. And if you think about that, it's sort of a way to capitalize or give transfer payments to the private sector. And that's really what QE has been all this time, right? It's not been giving money to the actual consumers, to the household. It didn't remedy any of the balance sheet problems that real families were having.
Right.
It flowed a bunch of liquidity into banks, which flowed into corporations, went on a spending spree, everybody selling lots of junky debt for very low yields. And really it was a massive releveraging in the corporate sector and in the government sector. But now that they're starting to say, oh, well, we can't keep this up indefinitely, you're having people cry that that's so unfair. And I would argue it's actually been ridiculous that it's gone on as long as it has, and that it gave preferential treatment to a certain part of the economy at the expense of everybody else.
And we've seen bank stocks, really come off steeply since the oil price has been declining as well.
Right, and that makes perfect sense too, because again, if you look at the TSX, Vanessa, 60% of the broad market was focused on financials and energy, right? That's where the bulk of the job growth came in the last couple of years. They were really partners in that pursuit. And so big job gains there, lots of capex spending, lots of underwriting of, as I say, on the debt side as well as the equity side. So that was kind of, they were making off like bandits while everyone else wasn't doing so well. And now what you see is they're actually joined at the hip. So when you get the breathtaking plunge in energy, you get a breathtaking plunge in energy companies, which came off really fast as well. And the same goes for the financial shares. They are late sector performers, so they've been late to couple with the rest of this stuff. But one of my favorite charts, and I've been showing it here for a couple of years, is a portrait of the various sectors that support the TSX and the Canadian economy relative to the 2007 peak, 2009 low, and the recovery that happened into 2011, and then what I call the great recoupling that's happened over the past 3 years, really. So you had the metals, minerals, and mining sector all come back down, right back to its 2009 low today, Vanessa.
Wow,
and you had the REITs and the finance shares in Canada really holding up, propping it up, so to speak. Energy now was one of the last holdouts, and it's come off a lot. It's not yet back to its 2009 low. But I think that that's where these things are headed. In the truth about price, the reality will be that none of the great inflation in the past few years was really sustainable.
I think speaking of the REITs, you've kind of been speaking and sounding the alarm a little bit about them, as well as just an overall decline in Canadian markets. So what's the status there?
Well, because if you think about it, what I just said about the leading indicators or the leading sectors of our economy retouching the '09 low, which everyone thought at the time was a cataclysmic end of the world event, but really it was just the business cycle and leverage that was so greatly put in coming out at a rapid speed. We always like to say that leverage and debt goes into financial markets and comes out about 3 times as fast.
Right.
So when you have a highly leveraged system, you should expect really abrupt price falls. That's sort of baked into overvaluations and over leverage. So once that starts to come out, you see everything fall in tandem. And the REITs, let's not forget, are heavily concentrated on the tenants, for example, in the commercial space,
right,
which have been largely a bunch of consumer retail space, which was overbuilt dramatically in the great, the noise of all this money flowing around gave people the wrong price signals. They thought that there was going to be great demand in the economy again. If we could just add more debt, people would spend.
Right.
But that actually hasn't happened. And now you got companies not being able to borrow at the rate they were, because it is always a finite exercise. You really can't borrow forever and ever and ever, right? It is a finite. It's tied to your revenue if you're a company, and it's tied to your income if you're a consumer. And so once you run kind of to the end of, like, you're not getting rising incomes for the consumer, but you also can't keep borrowing more. At some point, you're already tapped out. And the same for corporations, right?
Yeah. It seems like in Canada too, Canadians were more the savers versus Americans now. We've seen a big reversal in that. Canadian households are taking on a lot of debt. What are you advising investors to do out there?
So, as you know, in our last couple of conversations, I was saying that I was encouraged with the price discovery that was beginning to happen in the metals, minerals, and mining space. Because as I saw it, it was a making an honest sort of price point from something that had been a mirage, right? Full of credit and full of nonsense and trading. So you've seen that recoupling back with the real economy. Now, I think the real economy is weaker today than people are yet acknowledging. And I think that there's still a lot of leverage of people that were trying to hold out and hoping for a quick rebound. We see that in the narrative around energy in Canada today. We saw the federal budget, for example, be deferred until April. Alberta saying things like, we think we'll be okay, we think prices will bounce back in the 50 to 80 range.
They're toying with a tax, though, potential sales tax.
Well, they probably should pay a sales tax, right? Because here's the thing.
It's more steady.
If this is a secular decline, the way we've seen in prior cycles, then the oil price is not likely bouncing back, Vanessa, in the very near future. In fact, we could be in for a period of lower lows, as I say, into the pre-bubble phase. That would be in the sort of $20 to $30 a barrel range, and it may indeed stay there for a considerable period of time, which is going to be a reality check for people that are spending beyond their means, companies that borrowed too much. A lot of the sector had a lot of fat built into it the past few years.
It's going to have the whole province's GDP and take about almost 10 million off the nation's GDP.
Yeah, well, it was the leading engine of Canada's growth. It was the leading bastion of our tax revenues that were coming in. And so now we're into a whole new world, right? And this is why my talk today is called Repricing Assets for the New World Order, because I believe this is a secular shift. It will be painful for a bit longer. So things like the TSX, I still maintain, could revisit the '09 lows.
Right.
So from a 14,000 range, that's still potentially 50% downside once REITs and financials finally capitulate to the reality that Canada is unprepared for this downturn and that consumers have too much debt. So what should people do on the investment side? I think, as I said in the last couple of years, but it's been correct, keep your liquidity. Keep your credit. If you're going to be owning bonds, make sure they're very high quality, governments preferably, not a lot of corporates. You haven't been paid for the risk there. And just be patient, because the repricing cycle is underway here. Credit has been surging. The price of bonds has been falling, and those rates have been surging of late, and I'm encouraged by that. And I think we'll get, probably some more of that happening, and then we'll get an opportunity to buy back things like high yield debt when yields are more than 10%, and a lot of the price risk has been taken out. The same will come for financials and REITs.
Right.
But again, the downside from here could still be a lot, 30 to 50%.
Stay liquid and be patient.
That's worth waiting for.
Yeah.
You know, because your dividend yields then would be 7, 8, 9%.
Right,
And you won't
absolutely.
care if price doesn't bounce back quickly because you'll be being paid to wait.
Right.
And that is the essence of investing versus speculating.
Absolutely. Well, Danielle, it was a pleasure having you on today. Thank you so much for being here.
Thank you very much.